often get asked the question, do you invest in mutual funds or do you invest in individual stocks? Do you use bonds or do you use ETFs? And the correct answer is yes, we use all of that as it's appropriate for financial planning. So we're not tied to a set of products. We're not tied to any particular kind of investment vehicles. If you go to a mutual fund salesman, you're going to get a collection of mutual funds. If you go to a stockbroker, you're going to get a collection of large cap US stocks. If you go to a life insurance salesman, you're going to get whole life. And all of those products are great, but there's one thing that's come along that's new. There's nothing new in the world of finance in the last 50 years except exchange-traded funds, and they're new and they're very different. Let me tell you how they work. A mutual fund, first of all, an individual stock, you buy a stock in the company, McDonald's, Starbucks, whatever it is, and you own shares in that one company. It's difficult to get diversification because you have to own a lot of different companies, and buying each individual stock has a transaction fee, so you want to make sure you're investing $4,000 or $5,000 in an individual stock to make the transaction fee worth it. So individual stocks are great because they have low expense ratios. Their expense ratio is 0, and because they provide some tax diversification. You can sell your gainers or you can gift your gainers and sell your losers, and going forward you can do some tax management. Mutual funds, on the other hand, have a benefit because one mutual fund you can buy into with a very small amount of money, and you're invested in hundreds of different companies. So a mutual fund provides that kind of diversification. The problem with a mutual fund is that it's going to kick off capital gains because inside the fund manager is buying and selling stocks. So perhaps you bought the mutual fund today. Tomorrow, the mutual fund manager sells a stock he's held for 20 years. That stock has 20 years of capital gains, and you get saddled with the 20 years of capital gains simply because he decided to sell it while you were holding it. You may even have losses in the mutual fund, yet you have to pay the capital gains. So capital gains get kicked off whenever the fund manager decides, not when you decide. Unlike a stock where you buy it and you don't have to pay capital gains until you decide to sell it. Exchange-traded funds, also called ETFs, combine the best of mutual funds and individual stocks into one investment vehicle. First of all, they have very low expense ratios, lower than many of the mutual funds because they're usually built off some kind of an index. Second, they own a lot of companies, a lot of stocks, just like a mutual fund would own, but they own them put together in your shares. So unlike a mutual fund, when you throw your money in, it gets mixed in with everyone else's money. In an exchange-traded fund, when you buy a share of an exchange-traded fund, that gets put together on the spot, and it gets put together by a process of arbitrage. People bid for the right to put your share together, and whoever bids for the lowest amount of putting your share together, that's the one that wins. And so exchange-traded funds trade throughout the day like a stock. Their price goes up and down, and people are putting them together for as low as possible in order to be the one that puts your shares together. And so they trade almost always at net asset value of the underlying stocks throughout the day. But because your shares are put together, when you decide to sell it, you pay capital gains. But until you decide to sell it, your shares aren't traded, and therefore you don't have to pay any capital gains until you take some action. Now, sometimes the underlying index changes, and when that happens, whoever's put the iShare together, or the exchange-traded fund, or the power share, they will trade the share that's moving out of the index with the share that's moving into the index in what's called a 1031 like-kind exchange. And that's a fancy IRS term for giving up some shares and getting other shares and transferring your cost basis in what you give up to the cost basis of what you get. And because the cost basis transfers, it allows you to postpone paying any capital gains, even though you're getting rid of one stock and buying another stock. So far, exchange-traded funds have always been able to trade and exchange the shares moving out of an index for the shares moving into an index and preserve your cost basis so that you don't pay capital gains until you decide to sell it. As a consequence, exchange-traded funds are ideal for portfolios that are not large enough to diversify with individual stocks, but they're taxable accounts, and the taxable accounts aren't hit with capital gains until you decide to sell them. So exchange-traded funds make an ideal core of a portfolio between $500,000 and $1 million or $2 million. As you get over $2 million, individual stocks become more important because you can get more diversification in tax management. So exchange-traded funds are just a better mousetrap for use in investing.